Thank you, Vivek. I hope everyone's able to hear me loud and clear. Rohit, raise your hand if you're able to hear me. Great. So we can go straight away to slide 20 to talk about performance. So as you can see, this is a performance since a table on the left shows performance since inception for the PMS strategy, which was about 3.5 years ago in April 2019. The top row shows that last quarter was a fairly good quarter for the market. Market up, BSE 500 up 11.3%. Our team did quite well as well, up 13.8% for an outperformance of 244 basis points. However, year to date has been challenging. We've discussed earlier as well. And despite the outperformance of the quarter, year to date, we're still trailing the benchmark by 836 basis points. Black mark, if you will, on otherwise a perfect scorecard. As you can see in the prior years, every year the team has generated solid alpha, and since inception remains a very strong alpha generation track record with a CAGR of 19% compared to 15.8 of the benchmark, and cumulatively 86% net compared to 68.7 for 1700 odd basis points of alpha. We go to next slide, just some performance attribution on since inception basis, and we'll come to year to date as well in a few minutes, but just more importantly, sharing the since inception numbers. You'll see on the table on the right, gross of fee, these are gross of fee analysis now, 92% return. You'll see at the bottom of the second column, 92% return compared to 62. So 30% alpha, as you'll see in the bottom right-hand side box, of which 39% has come from stock selection, which is positive across each market cap segment, whereas market cap attribution has been -9%. The same can be viewed more graphically on the left-hand side chart, where the mid-cap sector delivered the highest alpha, all of it driven by stock selection, but large and small cap also delivered good alpha driven by stock selection. Next slide, if we go to, this is the sectoral attribution since inception. Same thing, you look at the bottom right-hand side table, the right-hand side table at the bottom row, 92% return of the portfolio, 62 benchmark, 30% overall outperformance, of which 32 has come from stock selection. Since inception, -2 has been the sectoral allocation effect. And on the left side, again, you'll see graphically, utilities has been the biggest detractor to the tune of 4.5% from a sectoral perspective, whereas on a stock selection basis, several sectors have contributed very handsomely, and most of them are positive. If we go to next slide, then this shows the top contributors and detractors from an individual name perspective. On the left side are the top contributors. You'll see Naveen Fluorine, Coforge, and so on. What's good to see is a very good distribution of contributors, which basically suggests that the law of large numbers is well at work. Performance has not been driven by one-off big hit, which may or may not be repeatable. So when you have a more granular contribution to performance, that's certainly more comforting, as it may be more attributable to skill rather than luck. On the left-hand side, sorry, on the right-hand side, similarly, the detractors also are reasonably well distributed. So the team's done a good job at position sizing and risk management, not allowing any single stock to draw a big hole in the performance. So you can see top 7 contributors are larger than the top detractor on the two tables, as you can see. Going to the next slide now, talking about more the quarter first. Here you'll see in the bottom row 14.5 compared to 11, so 3.2% gross alpha, mostly driven by stock selection, which is 2.9%. Yeah, a lot of it coming from large cap. Next slide, if you see, now a quarter is a very short time period, so not a whole lot of conclusion to be drawn from such attribution analysis for a quarter. Typically, these attribution analyses are most useful when done on a multi-year time frame, like at least 3 years or 5 years or even longer. But we're just sharing it so as to know just the facts. Not a lot of inference can be drawn, but just to show the facts. Here on the sectoral attribution perspective also, you'll see out of 3.2, 2% of alpha came from stock selection. Allocation effect was also 1.2. Most of the allocation effect was from the energy sector, as we don't own any Reliance, and Reliance Industries did, I suppose, underperformed in the last quarter, contributing to the sectoral outperformance. Next slide, please. These are the top contributors and detractors to performance. Left-hand side, you'll see the top contributors, Ambuja Cements, which obviously got acquired by the Adani Group and did very well since the close of the tender offer. But other names also like Titan, Estral, and so on contributed handsomely. Some of these have been long-standing positions in the portfolio. Others, like Ambuja, were added more recently at the time of the acquisition announcement. The right-hand side table shows the detractors continuing somewhat the trend of the year-to-date numbers, including the prior 6 months. The IT services names appear quite prominently, 4 of the 5, given the problems with global demands or worries about global demand slowdown, the fact that NASDAQ's been beaten up, down more than 30%, at least as of the end of the quarter, if I'm not mistaken, that contributed also to the underperformance of these names in the portfolio. Next slide. If we go to, this is more, a lot of analysis, I know, but might go through very quickly. This is attribution on a year-to-date basis, which has been negative. So you'll see on a market cap attribution perspective, minus 6.2% overall negative alpha on a gross basis, of which minus 5.5% is from stock selection, most of it coming from negative hit from mid cap. So in the since inception numbers, you saw mid caps were the biggest contributor to alpha. And that was even after including the year-to-date numbers, right? Because since inception include year-to-date numbers. But yes, year-to-date mid-cap segment, particularly the mid-cap IT names, which you saw on the previous, or you'll see in the later slide, the mid-cap IT names, which have since inception contributed quite handsomely to our performance, have hurt on a year-to-date basis. If we go to next slide, what's also hurt on a beyond mid-caps is the overall sector allocation. You'll see nearly half, or more than 40%, close to 45% of the negative alpha this year, as you can see from the bottom on the green columns, is due to allocation effect, where utilities have been on a rage, and they've contributed minus 1.4%, and IT services, which we were overweight, has contributed negative 1%. So these two predominantly have contributed to the minus 2.7 of negative alpha in the allocation effect. Next slide, please. Here are the names that have contributed positively year-to-date basis, led by Cholamandalam Finance, and the other names you can see quite a few of them common with, or 3 of them common with the last quarter's results. And on the right-hand side, you'll see top three names in terms of negative contribution, adding up to over 300 basis points, were from the IT services pack. Next slide, please. Now, so we talked about performance from a numerical perspective relative to the benchmark, market cap attribution, sectoral attribution. We also, during the last 2 calls, if I'm not mistaken, gone through the reasons for underperformance. What are the causes? And we've talked about under allocation to sectors like utilities, commodities, PSUs, which don't come out clearly through these standard attribution analysis, but we historically have hardly ever owned PSUs, or hardly ever owned utilities or commodities or energy. And those are the sectors on fire this year, if you will. Some of the top performing names, if we were to quickly go to that slide, Dipojal, have been from the top performing names have been from the those sectors. As you can see here on the right-hand side, left-hand side table, Adani Power, Adani Enterprises, Adani Total, and Adani Transmission, and Adani Green Energy. 5 of them from utilities. Sorry, these 5 names. One of them is mentioned as industrials, Adani Enterprises, because it's a holding company, but effectively it owns all these utilities, and bulk of the value is driven by these utilities. So 5 out of the top 10 names are utilities, and all happen to be Adani Group companies, which we haven't owned, and are large positions in the relatively large position in the benchmark. Then there are SOEs like Hindustan Aeronautics, Bank of Baroda, which we not own. I'm not saying right or wrong, but I'm just saying historically we've never owned these segments. Whereas sectors like consumer discretionary and private sector banks, which tend to usually be always overweight, particularly consumer discretionary has not done that well this year. And IT services this year was a considerable overweight, and that has been hurt, as you can see on the right-hand side. 7 out of the 10 names are IT services. Now, if we go back to, so this, I'm not going into too much details because it would be repetitive for a lot of you who joined us on prior calls. What we are going to do is look at peer group performance. So, earlier in or during this last 12 months, we have the team has won several awards, and we'll point those out in a couple of slides for top ranking performance over the last 3 years, 5 years, or even somewhat shorter time horizon, but more than a year. So it is somewhat of a dichotomy where the performance against the benchmark is the worst that we've ever had, and yet we are winning awards at a higher pace or larger number of awards than almost any other time that I can recollect in my 15-year track record. And this next few, and some of you might have noticed my LinkedIn posts congratulating the team and thanking investors on the achievement of these long-term awards. But so this would throw some light on this dichotomy. So what you see here, what the bar graph shows, is for each of the years you mentioned here on the x-axis since our inception at WhiteOak. Now, let me just caveat a footnote here, which is that obviously our PMS started in 2019, but we as a team started managing external money since August 30th or September 1st, 2017. So prior to April 2019, this analysis has used other representative portfolios like the AIF we've had, and before that, even the India Econ Fund, which is foreign money that we managed for a few months before the AIF track record is there. So all that footnote and caveats, what this is the performance of the WhiteOak team compared to the PMS peer group. And we've taken for this slide 24 data points. So every PMS scheme that has more than 1,000 crores, and Dipoj will correct me if I'm mistaken, but every PMS scheme that is multi-cap and has more than 1,000 crores of AUM, we've taken that. And what the bar represents, the green in the bar represents top quartile managers. The light blue, sky blue represents second quartile. The beigeish color is the third quartile, and the red is the fourth quartile. The yellow box in the middle is the benchmark performance. I assume everyone is familiar with what the quartiles mean. Top quartile is the top 25% by performance of the manager, and bottom quartile is bottom 25%, and so on, right? And the dark blue bar or line that is there, that represents our performance. Yeah. So even if you eyeball the graph, you'll see most of the years we are above or well above the benchmark and well above most of the peer group. This year, the benchmark is high up. And if you see on the right-hand side, on a 3-year and a 5-year basis, we are well above the benchmark again. And on a 5-year since inception basis, we are pretty much at the top, maybe second from this graph of more than 1,000 crores, right? And the table below, you'll see for each of these years, partial or full years, the performance of WhiteOak compared to the benchmark and the alpha generated. Very solid alpha, something that you saw in the tabular format earlier as well for the PMS strategy, and similar yearly over here mentioned. On a year-to-date basis, minus 835. On a 3-year and 5-year basis, still very solid alpha compared to the benchmark, obviously lower than our longer-term averages, but yet very solid when compared to peer group. If you see in the next slide, that would become more evident. So last 3 years have been a time period where benchmark itself has done quite well. What you see here in this table is out of the previous batch of 24 managers, what we've including the benchmark, what we've done is selected the 10, because it's 10 is just, otherwise the data becomes too difficult to follow or talk about. Here, WhiteOak and the rank ordering is obviously we've hidden the names of the peers, but these are the top 10 or excluding the benchmark, top 9 PMS fund managers or fund schemes by AUM. All of them are above 2,000 crores. And you know, basically there are no other, besides this, there are no other multi-cap portfolios over 2,000 crores. So we've included everyone that is more than 2,000 crores, which is 9 PMS schemes for multi-cap. And we've added the benchmark here as well, S&P BSE 500. And then we look at, it's the same data, underlying data as the previous chart, but presented with the underlying numbers as well, and a little bit more data. So you'll see the WhiteOak strategy. Obviously, the darker the shade of blue, the stronger the performance, and the darker the shade of red, the weaker the performance. And the assortment is done basis the best performance over a 5-year period or since inception. So you look at the rightmost column, you'll see WhiteOak is at the top, as I was saying in the previous slide, at 19% compounded return over a 5-year or little over 5-year time period since September 2017 at 19% return. The second best is 17.1. The third best PMS is 14.2. So drops quite dramatically between the first and the third. The difference is nearly 500 basis points compounded annualized. And then the benchmark itself is 13.8% over this time. On a 3-year basis, we are second best performing at 20.7% return. You'll notice that on a 3-year basis, interestingly, the 10th best manager from a 5-year basis is the best performing manager on a 3-year basis. So some managers can have a very volatile return series, which is the case with the bottom ranking manager, because if you see in 2017 the manager was second best performing. Then in 2018 and 19, both years were worst performing. And then 2021 was the best performing, and so on and so forth. So 3-year is best, but 5-year is worst performance for that manager. So I hope this is data that is not too confusing to look at, because there are a lot of numbers. But if you either look at the numbers or look at the shades of blue and red, and you'll figure that who has performed how, get a picture of how someone has performed. You'll see on a year-to-date basis, which is third column from the right, the benchmark is the best performing at 4.6%. Okay, the second best performing is 1.4%. All right, so in a way, the best performing manager of these top 10 is behind the benchmark by 320 basis points as of September end. So it has been a year where benchmark has left everyone behind. If you go to next slide, this is again same underlying data presented in a graphical format without the numbers and with a color coding, which might be helpful to see how over time these top 10 managers or 9 managers plus the benchmark have moved in their ranking from year to year. And then where is their ranking in 3-year and over since inception, or 5 year, which I've mentioned earlier, but this is like in a way summarizing. So WhiteOak, obviously we've chosen the color to make it stand out, but the dark blue color is that of WhiteOak. So in 2017, which is only 4 months, but we were best performing of these 10. 2018, we were second best performing. And the white one is the benchmark. So you can see where we are relative to benchmark. In 2019, which actually compared to the peer group was our worst year, because you'll see 2019 till now is the only year when, amongst the top 10 managers, there were more managers who outperformed compared to us versus underperformed compared to us. Though we still outperformed the benchmark that year, but there were 5 managers who outperformed us amongst these top 10 compared to 3 that underperformed us. And then 2020, we were again the best. 2021, we were the 3rd best out of this group. Now 2022, we are middle of the pack compared to the peer group. The benchmark is, as you can see, the best performing. There are 4 managers ahead of us from the top 10 and 4 managers behind us. We are middle of the pack. So fairly strong and fairly high degree of consistency in our performance, most of the time above the median, and on a combined 3-year basis, we are second best. The benchmark itself is 3rd best. So it's been very difficult over the last 3 years. Very few managers, in fact, as this shows, only 2 out of the top 10 have outperformed the benchmark for a trailing 3-year basis. And on a since inception, which is a 5-year basis, we, as the prior slide also showed, we are top ranking, and benchmark is more or less middle of the pack, but slightly better than the middle, where 4 managers have outperformed and 5 have underperformed. As again, you can see portfolio number 8 or fund manager number 8 was in top ranking in a 3-year basis, but bottom of the pack on a 5-year basis. So a lot of information to digest, but I thought rather than presenting performance analysis in the same fashion as we did the prior 2 quarterly webinars, we'll present it in a different form so that you get a perspective of what's the landscape, how various players, if you will, are playing this year and over the trailing several time periods, as we spoke about. And next slide, if we go to this relative peer group, because when you get an award, it's like when you win the World Cup, which unfortunately India is out of, but when you win the World Cup, it's not on the basis of how many runs you score in absolute, but it's on the basis of whether you scored more than your opposition. You can score 200 runs and yet lose it. You can score 100 runs and yet win it in the T20. So the awards we won, these are all the awards that we won year to date or the last 12 months. As I was saying, this is greater frequency of winning awards than any other year in my nearly 16-year career. Most recently, last week, we won a very prestigious CityWire. CityWire is one of the, if not the most well-known publication in Europe. So a lot of these awards are from global agencies or global institutions, just because there are many more of those outside India. In India, we don't have so many publications or agencies or otherwise institutions who are creating these awards. So November 2022, we had Ashoka India Equity, a UK listed trust, win the Best Emerging Markets Single Country Award just last year. This is for a 3-year performance record. Not only were we ahead of any other Indian manager in the universe, but also ahead of any other single country, be it China, Vietnam, Brazil, or anyone else. Ashoka India Opportunities Fund, our UCITS fund, earlier in the year, mid-year, won the Best Investment Week Fund Manager of the Award. And then, Lipper Awards are extremely, all these are highly reputed awards. And Lipper is universally, not just in Europe or institutional market, which is what the Investment Week is more focused on, but universally Lipper is very well recognized award, and many of you on the call might have heard about it. And we won the Lipper Award for the best fund in the India equity funds category out of 40 India funds for a 3-year period. And similarly, earlier in the year, we won in India. In February, we won the PMS AIF World Award for the best PMS on a 2-year performance in the multi-cap category. And finally, in November 21, we won the HFM Asia Performance Award for the best UCITS funds. Again, we also won, I think we're missing one over here. I recollect we also won within the last 12 months, I believe, the Morningstar award, or it was possibly just the 5-star rating and not an award of sorts. So I take that back. But these are 5 awards over the last 12 months. And this is basically because compared to the peer group, our team has done a has delivered very strong performance over the last 3 years, 5 years, or even on a year-to-date basis. While it is far behind the benchmark, but on a peer group basis, as we saw, is disappointing that it is middle of the pack. But given the stronger performance last year and the year before, still ranks in the top performing managers.